Low volatility anomaly. The low volatility anomaly is the observation that low volatility stocks have higher returns than high volatility stocks in most markets studied. This is an example of a stock market anomaly since it contradicts the central prediction of many financial theories that taking higher risk must be compensated with higher returns. Furthermore, the capital asset pricing model, CAPM, predicts a positive relation between the systematic risk exposure of a stock, also known as the stock beta, and its expected future returns. However, some narratives of the low volatility anomaly falsify this prediction of the CAPM by showing that stocks with higher beta have historically underperformed the stocks with lower beta. Other narratives of this anomaly show that even stocks with higher idiosyncratic risk are compensated with lower returns in comparison to stocks with lower idiosyncratic risk. The low volatility anomaly has also been referred to as the low beta, minimum variance, minimum volatility anomaly. History. The CAPM was developed in the late 1960s and predicts that expected returns should be a positive and linear function of beta, and nothing else. First, the return of a stock with average beta should be the average return of stocks. Second, the intercept should be equal to the risk-free rate. Then the slope can be computed from these 2 points. Almost immediately these predictions were empirically challenged. Studies find that the correct slope is either less than predicted, not significantly different from zero, or even negative. Black, 1972, proposed a theory where there is a zero beta return which is different from the risk-free return. This fits the data better since the zero beta return is different from the risk-free return. It still presumes, on principle, that there is higher return for higher beta. Research challenging CAPM's underlying assumptions about risk has been mounting for decades. One challenge was in 1972, when Jensen, Black and Scholes published a study showing what CAPM would look like if one could not borrow at a risk-free rate. Their results indicated that the relationship between beta and realized return was flatter than predicted by CAPM. Shortly after, Robert Haugen and James Hines produced a working paper titled On the Evidence Supporting the Existence of Risk Premiums in the Capital Market. Studying the period from 1926 to 1971, they concluded that over the long run stock portfolios with lesser variance in monthly returns have experienced greater average returns than their riskier counterparts. Evidence. The low volatility anomaly has been documented in the United States over an extended 90-year period. Volatility-sorted portfolios containing deep historical evidence since 1929 are available in an online data library. The picture contains portfolio data for U.S. stocks sorted on past volatility and grouped into 10 portfolios. The portfolio of stocks with the lowest volatility has a higher return compared to the portfolio of stocks with the highest volatility. A visual illustration of the anomaly, since the relation between risk and return should be positive. Data for the related low beta anomaly is also online available. The evidence of the anomaly has been mounting due to numerous studies by both academics and practitioners which confirm the presence of the anomaly throughout the 40 years since its initial discovery in the early 1970s. Examples include Baker and Haugen, 1991, Chan, Karski and Lakonisok, 1999, Janganathan and Ma, 2003, Clark da Silva and Thorley, 2006, and Baker, Bradley and Wergler, 2011. Besides evidence for the U.S. stock market, there is also evidence for international stock markets. For global equity markets, Blitz and Van Vliet, 2007, Nielsen and Ayler Subramanian, 2008, Carvalho, Xiao, Mulan, 2011, Blitz, Pang, Van Vliet, 2012, Baker and Haugen, 2012, all find similar results. Explanations. Several explanations have been put forward to explain the low volatility anomaly. They explain why low-risk securities are less in demand, creating the low volatility anomaly. For an overview of all explanations put forward in the academic literature, also see the survey article on this topic by Blitz, Falkenstein, and Van Vliet, 2014, and Blitz, Van Vliet, and Baltussen, 2019. Also see